A rocky few days on the markets, and joining us on that right now, Stephanie Link, Chief Investment Strategist at Hightower and a CNBC contributor. Stephanie, good morning. So,
good morning.
What's driving the markets right now? Yesterday, the tech sector on the S&P was down dramatically more than lots of other stuff. Semiconductors having a particularly bad day, but are things just trying to find some equilibrium now? What do you think's going on?
Yeah, I think so. I feel like we've hit kind of a volatile time ahead of earnings. Next week is going to be great in terms of earnings, because I think earnings are going to give us a better picture. But for the time being, we've kind of hit this air pocket. We're trying to figure out where rate cuts and how many rate cuts are going to occur this year. I'm kind of getting into this camp of maybe no cuts, and I don't think that we need cuts because we have better growth. Especially earlier this week, we had the IMF revise global growth higher to 3.2%. We had better China GDP growth at 5.3%. Here in the States, we're running at about 2.9%. And so that all of this growth, this dynamic is keeping inflation elevated. And so the Fed doesn't really have to do anything. But all of this means that we're going to see better earnings. And so that's why I'm looking forward to next week. And we had some good earnings even this morning with D.R. Horton.
So in what we tend to think about as earnings season every quarter, banks go first, the big banks, the regionals. What's your takeaway from the bank reports, really the fundamentals versus just the stock action?
Yeah, I always think that banks kind of trade a little funky around earnings because the headlines are kind of messy, and they were messy. But I do think that the one message I took away was that capital markets are certainly improving. The IPO pipeline is actually improving and making progress. And I think that the expense line was really quite remarkable for many of the companies. And so, to me, I thought the standout was Morgan Stanley. I have been buying it. I will continue to buy it at 13 times forward estimates. I think they hit it out of the park, quite frankly, in terms of their institutional business, the wealth management business, and again, the expense side of the equation. You have a new CEO, and everyone's kind of trying to figure out what that means. He's got a great track record, though, especially on the institutional side, and I think they're going to continue to gain market share. I thought Citigroup did a great job on the expense line. I thought Bank of America did a great job on the net interest income on a sequential basis relative to its peers. So I think you pick and choose, and I think the sector is quite cheap.
You know, Steph, it's interesting to just think back to where the kind of economic narrative was at various points in time. We had mass certainty we're going to get a recession, 15 months ago. Yeah. Even last October, we felt like the economy couldn't handle rates where they are right now. And now it's sort of like, hey, we got a 3% economy. The rest of the world's growing. I'm just wondering if we're going to overshoot a little bit and say, you know what, maybe rates are biting. You're starting to see some consumer-based companies suggest that demand is a little bit soft, or maybe people are very price sensitive. So I'm just wondering about the next move in the narrative as we see bond yields, take a breather, even oil coming down a little bit.
Absolutely, Mike. I mean, I get nervous because everybody last year, to your point, was thinking that by now we'd be in a recession, and now everyone today is thinking everything is so great. So I respect that very much. But I do think that the consumer continues to be strong, and we're all watching the job market, the labor market, and the labor market continues to be quite tight. And I look at wages at 4.1%, and I look at if you want to switch to a job, you can get a 10% wage increase. And so that has led to a very resilient consumer. And I do think that at the same time, we've got $9 trillion, according to Larry Fink at BlackRock. We've got $9.1 trillion in money market funds. And so that's a nice support and a tailwind for equity markets should we see a pullback. So, yeah, we're going to be rocky. Nothing is perfect. But I do think earnings are going to pull through. And that's the most important thing and the most important takeaway for me. If I got nervous about earnings, I would be nervous about the market. And I'm not nervous about earnings at this point.